In this example problem, we are going to secure some borrowing by putting our receivables up. There's two ways that you can go about doing this. The first is just using them as collateral. And if you use them as collateral, you're not guaranteeing anything to the company that you're borrowing from in terms of like a cycle of payments. You're just guaranteeing overall that if you default on your loan, they're going to take whatever they have as collateral. But you can also assign receivables. And when that happens, basically what's happening is they own the receivables, the entity that you're borrowing from. And you're going to act as the middleman. So when you collect on these receivables that are now assigned, you directly pay or remit that money to the place that you borrowed from. So on September 15th, Bad Joe Board Games over here is going to borrow funds from Empower Finance by securing a revolving line of credit. Interest payments on this are going to be due at the end of each month, and at the same time, we're going to remit the payment of any collected receivables we have over to Empower Finance. So we're going to give them the amount of the assigned receivables that our customers paid us plus the interest charge. And the amount that we have to work with over here is that we are borrowing $900,000 originally. On this credit line, we have a 6% APR, so every year annual percentage rate. We have to get hit with a 6% charge on any outstanding principal balance that we have on our line of credit. Typically, when this happens, I shouldn't say, oop, sorry, I shouldn't say that is collateral. It's a bad terminology, or then we fix that for you. For amount of receivables assigned, there we go. We are going to put up $949,000 in receivables. And when this happens, typically you will have to put up more receivables than the amount you're borrowing. Why? Once again, bad debt. There's probably bad debt in there. If you just put up 900,000, one person doesn't pay you, well, now you don't have $900,000 of receivables. So you'll have to assign a greater amount of receivables than you borrowed. That doesn't mean, though, that if there is, in this case, less than $49,000 in bad debt, that you have to pay it all over. Once you've paid off your principal balance, you're good to go. So we have how much we are assigning to this other entity, how much money we're borrowing, the APR on the line of credit that we have, and we also have how much of these assigned receivables our company collected each month during a 3-month time frame, three-ish month time frame, $150,000 in September, $491,000 in October, and $118,000 in November. Well, we can do some math right now to figure out what our numbers are going to be. So September is when we take out this line of credit, which means the beginning balance at the time would be $900,000. For interest expense over here, we have that interest formula we always use, which is principal times rate times time. So here, our interest expense for September is going to be equal to the beginning balance, the principal, times the stated rate of interest. That's 6%, but it's 6% for the year. So we need another fraction that accounts for time. And we are opening this line of credit on September 15th, which means half of September is passing. So it's definitely not going to be the full year of 6%. We could multiply it, and I'm going to, by 1/12 to make it a monthly amount. But a full month didn't pass between September 15th and the end of September when our first payment is due. So I'm going to multiply that one more time by 1/2. Or if I wanted to, I could have just multiplied that by 1/24 to make it one fraction, but I didn't want to be too confusing. So now when I hit that, I come up with 2,250 bucks. We know the amount of receivables that we collected, which we've assigned and therefore have to remit payment to Empire Finance for, which was 150,000. So in total, the amount of cash that we are going to pay to Empower is the $150,000 worth of the assigned receivables that we collected, plus the 2,250 interest charge. So we owe them 152,500 bucks. What will our ending balance be? Do I reduce this by 152,250? And the answer is no, because at 2,250, that's Empower's finance charge. That's how lenders make money. We're only going to reduce the ending balance by taking the beginning balance and subtracting out the actual amount of receivables that we are remitting payment for. So $150,000 of the receivables get applied to this principal balance, knocking it down from 900,000 to 750,000. For October, whatever you end one period with, you begin the next period with. So we're going to begin this with 750,000. Now I don't have to do that goofy thing where only half of a month passed. We'd be ticking interest on this for the entire month of October, while this loan is outstanding. So what is our interest expense here? Well, we started the period with $750,000 worth of principal balance still remaining. The APR is still 6%, and now I can just convert it to monthly by multiplying by 1/12, and I come up with 3,750. We collected $491,000 worth of receivables during October, according to our information, which means when we transfer payment to them, we're going to transfer or remit all of the collection of receivables, the $491,000 plus the $3,750 of interest expense. Now I've got $494,750 that we're going to have to send out to this lender to Empower Finance at the end of October. But our ending balance is only going to get reduced by the amount of receivables that we remitted. So it's going to drop from 750,000 by 491 grand down to 259,000. That's what we end October with. What we still owe after we make October's payment. And then therefore that's what we're going to owe when November starts, 259,000. Interest expense, same thing again. Take your beginning balance, multiply it by your stated APR of 6%, and this is still going to be for a whole entire month because we only pay at the end of the month, so that amount would have been outstanding for the entirety of November. Multiply that by 1/12 to turn our annual rate into a monthly rate. Comes out to 1,295. We collected $118,000 worth of receivables during November, and we have to remit all of that payment to Empire Finance. So when we send them money, we're going to send the interest charge plus the remitted receivables one more time. And November's payment is going to be $119,295. And then what do we still owe them? Well, we started with 259,000 that we owed them. We're sending them remitted payment of $118,000 in the collection of receivables. We're now down to $141,000. And this would go on and on and on until we eventually paid this thing off. But for the purpose of this question, I think you see the trend that is going on with our amortization table, if you will, over here. So let's jump to the journal entries. To record the journal entry to account for the receipt of the initial amount borrowed on September 15th on 9/15. How do we do that? Well, we're getting cash. That's why we are assigning these receivables to Empire Finance. And how much are they going to give us originally? They're letting us borrow $900,000. And like all lenders do, when you make a borrowing with them, you have to sign a promissory note saying you agree to repay it, some terms of contract, if you will, and we book that as accountants under notes payable. So we borrowed from Empower on secured credit line. In requirement 2 over here, we need to assign the receivables to Empower and on our books, just so we know that we aren't the ones intending to collect those receivables, we are going to move them into a different type of receivables account called assigned account receivables. So these are receivables that we are identifying that whenever they get paid to us by the customer that owes us the money, we don't get to keep the cash. We are going to have to send it off to whomever, in this case, Empower, we assigned it to. And that makes it different from the other receivables on our books because we don't get to collect the cash in the long run. So if you're going to assign some receivables, put them into assigned accounts receivable, singular, and take them out of your regular accounts receivable account. What amount did we assign? We assigned 949,000. And here we assigned receivables to Empower. And from here on out, we're just going to have a big fat series, if you will, of using that table that we made above to continuously pay Empower. So what I'm going to do over here on September 30th, we need to account for our collection of these receivables. So step one, we're going to collect from the customers that owed us, but since we assigned it in the next step, we're going to pass that on over to the party we assigned it to. But this entry is just us collecting from customers. And it's the same entry you've seen a million times in your accounting studies. Whenever you collect cash from customers, you Debit cash for the amount you're collecting. This is for September's collections. Our information tells us that we are going to collect $150,000 in September. So it's debit cash for 150,000. And we reduce our receivable account. And since these receivables were assigned to Empower, we're going to reduce assigned accounts receivable. I cannot type right. There we go. Had the S in the wrong spot up there. There we go. So we're going to reduce that account by 150,000. And here we recorded September collection of assigned receivables. And now that we have the cash from that, because of the terms that we came to with Empower, we have to remit that $150,000 in cash to our lender, to Empower Finance. But that's not all the cash we have to send them because we're also getting hit with an interest charge. So this entry is going to have two debits, 30, excuse me, it's the end of September. One denotes payable for the amount that our principal balance is going down by the amount of assigned receivables that we are transferring to our other party, which we know to be 150,000. Then we're going to have a second debit to interest expense for the interest charge that we have to pay on top of the amount of money that we're transferring over from the collection of receivables. Interest expense, according to our chart up here for September, was $2,250. So all in all, I know I'm going to need a credit of 152,250 to make my journal entry balance, which good for us is what our chart on top says the cash was paid to Empower. And here we remitted September collections to Empower. In requirement 5, we're going to rinse and repeat the process. Like it's seriously doing the same thing over and over again every single month while you have assigned receivables on the books. Every time you collect, it's a debit to cash over a credit to assigned accounts receivable. This one would be for October's collections. That was happening on 10/31. And the amount of cash that we collected in October, according to the information in this problem, we collected a ton. We collected $491,000 of receivables. So we're receiving $491,000 worth of cash. Those assigned receivables have to come off our books, so we'll credit that for $491,000. And here we recorded, anybody wants to fill it in, recorded October collection of assigned receivables. And then once you have them and you got that cash in hand, you unfortunately don't get to keep it because you assigned the collection of those receivables to another party, which means you got to transfer cash to them and also pay on top of the collected receivables an interest charge. So this is always going to be the entry every time that you transfer funds to the other party in this transaction. You're going to have a debit to notes payable, a debit to interest expense, and a credit to cash. And you can take those numbers right from the table up on top. Notes payable gets debited for the amount of receivables being collected, which was 491,000. Interest expense gets debited for the amount of interest expense you're getting hit with for that month. So October, it's 3,750. And your cash gets credited for the total amount of cash in your table that you said that you were going to pay. And we're going to have to pay $494,750. And here, this is all occurring again on October 31st. We remitted October collections to Empower. On November 30th, we need to account for the collection of assigned receivables. Again, guess what? We can just copy and paste. Thank you, Excel. Whenever we collect unassigned receivables, a debit to cash, credit to assigned accounts receivable. And during November, our collections are saying that we brought in 118 grand from customers on receivables, which we had already assigned to Empower. So debit to cash for 118 grand, credit to assigned accounts receivable for 118 grand. And here we recorded the November collection of assigned receivables. In requirement number 8, one last time, we are going to transfer payments to Empower Finance for the receivables we collected on their behalf during the period, plus the applicable interest charge. And we're once again going to steal those numbers from the table that we had up on top. So we're going to have a debit to notes payable for the amount of principal we're paying off with the remitted payment of receivables, the 118,000. We're gonna have another debit to interest expense for the interest charge that was hit on our loan, which is $1,295. And we're gonna have a credit to cash for the total amount of cash that we're transferring to this other party, to Empower, which I think is 118,295. And on November the 30th, we remitted November collections to Empower. So, a couple of questions that I always get asked in this case, like what happens after you've collected all of your assigned receivables and you've sent them to the other company, you got zero debt outstanding. We still owe Empower at this point in time when I'm ending this problem, 141,000. What happens when $141,000 gets paid off? Do you need to assign more receivables? And the answer is it all depends. But for the most part, no. You've proven your credit worthiness at this point in time, and they'll let you have a credit line that revolves. That's the most likely scenario, but it's not a 100% given. Sometimes if you are going to substantially borrow on a line of credit, like above a number, a certain number, above 100,000 or whatever, they will ask you to assign them more receivables. But for the most part, it's not going to be a penny for penny thing like it is right here when you first start the loan. So I'm thinking in this problem right here in Power Finance, knew nothing about Banjo board games, and they really made it happen in this case. What if you aren't directly assigning the receivables? What if you are just going to use them as collateral? Well, then you don't have to separate your books out because you don't have certain receivables on your books that you're now obligated to pay to somebody else. You're obligated to pay them in whole, but it could be from any source, any money that you get. It's not just tied to the collection of receivables. So if you are just using receivables as collateral, you ain't got to worry about this at all, about moving yourself into an assigned accounts receivable account. Procedure would just skip all of that. You would have your note on the books, and then at the end of the period, you have to figure out what your interest charge is and reduce the principal balance, how much you are paying them that goes towards principal, record the interest expense towards a portion that went towards interest, and ultimately reduce your cash by the total amount that you're sending them.